An interesting signal has emerged recently, one that many experts believe marks a major turning point in global finance. Gold mining companies, which have always stood as the foundation of the traditional financial system, are now beginning to place portions of their treasuries into Bitcoin. This is no small move. It suggests a deeper transformation, that Bitcoin is slowly beginning to replace gold as the preferred store of value. For decades, gold has been considered untouchable, the ultimate hedge against uncertainty. It was the asset people turned to when currencies collapsed or when inflation surged. But now, something remarkable is happening. The very institutions and companies that mined gold for centuries, the ones that once depended on it for their wealth and stability, are quietly turning away from it. These miners are now buying Bitcoin and adding it to their balance sheets. This shift is as shocking as if Coca-Cola suddenly started investing in Pepsi. It's not merely a business decision. It's a symbolic statement. It says that the future of money might not come from what we dig out of the ground anymore, but from what we build through digital innovation. Max Keiser, a financial commentator who has long predicted this transition, believes we are witnessing gold's gradual demonetization in real time. Capital is moving out of gold ETFs and flowing into Bitcoin ETFs. Mining companies are no longer hoarding gold. They're accumulating Bitcoin. This shift implies that gold's dominance as a $20 to $21 trillion asset could soon be challenged by digital scarcity. If even a fraction of that massive gold market migrates into Bitcoin, the price could explode to levels previously considered unimaginable, potentially between $800,000 and $900,000 per Bitcoin. This is the bullish scenario Keiser describes. Corporate treasuries and institutional investors are buying heavily, though he warns that Wall Street may still attempt to control and manipulate Bitcoin through traditional financial tricks. Yet, as history shows, every attempt to contain revolutionary technologies eventually fails. The digital age always finds a way to move forward. What's happening is more than just hype. It's a structural shift, a slow-motion financial earthquake that many investors still haven't fully grasped. As capital transitions from gold to Bitcoin, the question isn't whether change will happen, but how drastically it will reshape the global economy. Will traditional markets adapt, collapse, or evolve into something entirely new? Are we witnessing a silent reset of the financial system, or the first act of a worldwide monetary revolution? At the same time, major political decisions are reinforcing this transformation. The U.S. government recently opened the door for 401k retirement funds to invest in cryptocurrencies, unlocking access to nearly $9 trillion in savings. This means millions of Americans can now allocate their retirement assets into digital currencies, accelerating mainstream adoption. Even sovereign nations are joining the wave. President Nayib Bukele of El Salvador, often referred to as the Bitcoin president, has become a global symbol of this movement. Under his leadership, El Salvador became the first country to adopt Bitcoin as legal tender, setting a precedent that other nations are beginning to study. Keiser explains that countries across Central and South America are forming what he calls an axis of Bitcoin, where national leaders are actively exploring Bitcoin adoption as part of their monetary strategy. He even mentions that Panama and Pakistan are moving towards similar initiatives. Pakistan, for instance, has reportedly begun discussions about developing a Bitcoin strategic reserve. Sovereign wealth funds, the massive investment arms of nations, are now quietly exploring or directly investing in Bitcoin. This means Bitcoin has officially reached the sovereign level of global finance. The ripple effects are profound. Hedge funds, large asset managers, and sovereign institutions are increasing their allocations. Figures like Larry Fink, CEO of BlackRock, have gone from dismissing Bitcoin to embracing it, increasing recommended portfolio exposure from 1% to potentially 15%. The movement has gone beyond speculation. It's becoming a fundamental part of the modern financial architecture. In Keiser's view, this represents the endgame for the traditional central bank and nation-state model, which has operated for more than 300 years. The fiat currency system, based on endless debt and money printing, is reaching its breaking point. Bitcoin, with its finite supply and decentralized nature, is emerging as a credible alternative, perhaps even the next global reserve standard. When you consider the math, it's staggering. The total global wealth, including real estate, equities, and fiat currencies, is estimated to exceed $400 trillion. Compressing even a fraction of that value into Bitcoin's fixed supply of 21 million coins results in theoretical valuations that stretch into the millions per coin. Some analysts, including Michael Saylor of MicroStrategy, have projected that Bitcoin could eventually reach $13 million per coin under this long-term model. Saylor's own story highlights this transition. In 2020, he had $500 million in corporate cash that he could have easily used for traditional stock buybacks, like most CEOs do to inflate share prices. Instead, he made the unprecedented decision to convert that cash into Bitcoin. That single move changed corporate finance forever. He later began issuing new stock and bonds to raise more capital, not to expand operations, but to buy even more Bitcoin. His approach challenged decades of financial convention. Rather than diluting shareholder value, he argued that buying Bitcoin actually increased long-term value because Bitcoin supply was fixed while demand was accelerating. Saylor's strategy has inspired many other corporate leaders to follow his example, though not all understand the deeper philosophy behind it. Keiser warns that as more companies emulate this strategy, taking on debt to buy Bitcoin, the market may experience another boom and bust cycle. When Bitcoin inevitably corrects, those over-leveraged companies could face heavy losses, triggering broader market volatility. Yet, these corrections are a natural part of Bitcoin's long-term cycle, a pattern that repeats roughly every 4 years. Despite these fluctuations, Bitcoin's long-term growth remains unmatched. From a risk perspective, owning Bitcoin directly is far simpler than owning shares of Bitcoin-related companies. Stocks carry risks tied to management, regulation, and competition, whereas Bitcoin itself has no such dependencies. Even after multiple corrections, Bitcoin's compound annual growth rate still surpasses every major investment asset in history, outperforming legendary investors like Warren Buffett several times over. This shift is happening not only among corporations but also among miners and energy producers. Marathon, one of the largest Bitcoin mining companies, recently added hundreds of Bitcoin to its own treasury. This trend signals that miners themselves are becoming holders, not just producers. Analysts suggest that even a 1% or 2% rotation of gold's $17 trillion market into Bitcoin could send its price into six-figure territory. Bitcoin's technological advantages are clear. It's scarce, programmable, and verifiable on-chain, qualities that gold cannot match. Global crypto ETF inflows have reached record highs, reinforcing institutional confidence in this digital transformation. While some banks suggest gold and Bitcoin may eventually coexist by 2030, the momentum right now is clearly leaning toward Bitcoin. Energy companies could become the next wave of adopters. With massive cash reserves and global reach, corporations like Saudi Aramco could dramatically move markets if they began buying Bitcoin directly. The mindset across financial markets is shifting rapidly. The old debate about Bitcoin's energy consumption is evolving into a new discussion: how energy producers can integrate Bitcoin into their long-term strategies. On the ground, adoption continues to grow through circular economies, communities where people earn, spend, and save entirely in Bitcoin. In countries like El Salvador, towns have already begun to operate fully within Bitcoin ecosystems. These microeconomies are gradually connecting, forming the early infrastructure for a truly global Bitcoin economy. Even major financial institutions are preparing for integration. Banks are developing systems where Bitcoin can be used as collateral for loans or credit cards, merging traditional finance with the digital economy. As these systems roll out, Bitcoin will become increasingly monetized, no longer just a speculative asset but a fully integrated component of the global financial system. However, Keiser reminds us that Bitcoin's true purpose is deeper than investment. It's about separating money from the state, just as humanity once separated the church from the state during the Enlightenment. This philosophical shift represents a new era of personal sovereignty, where individuals can hold wealth that no government or institution can confiscate. Bitcoin is the only form of property in history that cannot be seized, censored, or inflated away. Even if the internet went down, Bitcoin's decentralized network could still operate through alternative communication systems, ensuring that ownership and transactions remain secure. This realization is transforming entire nations like El Salvador, where people now have access to money that truly belongs to them. It provides not just financial empowerment, but hope, a sense that a new economic era is beginning. The world is witnessing a monumental rotation of capital, from gold, silver, and fiat currencies toward Bitcoin. October 2025 marked a turning point when traditional safe havens began to falter and Bitcoin surged past $112,000, briefly touching $125,000. This wasn't just a price rally, it was a redefinition of how wealth is stored and protected. What once seemed like a fringe movement has become the foundation of a new financial paradigm. Institutions, corporations, and even governments are realizing that Bitcoin is not just digital gold, it's the backbone of a new monetary system. As this transformation accelerates, the financial world faces a simple but pressing question. Can it afford to ignore Bitcoin any longer? Would you like me to extend this a bit more, to about 1700 to 1800 words, so it has extra padding for voiceover pacing in your YouTube videos?